Good morning and welcome back to Bulls, Bears, and the Bell. It is Friday, November 21st, 2025. And if you are staring at your screens this morning, wondering if the market has a violent case of cognitive dissonance, well,
Yeah,
you're absolutely right.
you couldn't have said it better. It's
Yeah.
it's a ferocious, almost schizophrenic pre-market. On one side, you have this massive surge in U.S. equity futures, a textbook euphoria rally. But then you pull back the lens just a little bit, and you see this global risk-off rotation that is just challenging the entire bull thesis.
It's the ultimate market tug of war, isn't it? AI excitement is battling this really deep-seated global anxiety.
Right.
So our mission today is laser-focused. For you professional traders out there, we need to strip away all this volatility and find the true signal over noise. We're going to identify exactly where that institutional capital is flowing, what levels really matter, and what the primary hypothesis for the day is, especially with the Fed now in an easing cycle.
And we have critical data hitting at 8:30 a.m. ET. Plus, a geopolitical situation that just keeps shifting the energy landscape. This is not a day for guessing, it's a day for precision. So let's unpack it.
All right, let's start with that immediate, that visceral market impulse. The reason U.S. futures look so strong. And that strength is entirely traceable back to one name, NVIDIA. It's all about their earnings and forward guidance.
It wasn't just a good report, it was a defiant one.
Mm.
The CEO's commentary was pivotal. He actively and for now successfully shrugged off any concerns of an AI bubble.
Right, he basically said we're in the early innings.
Exactly. He injected this massive dose of fresh confidence, and that didn't just validate their success, it validated the entire concentrated tech trade. It sparked a huge short squeeze, especially in the NQ, and it just dragged the S&P 500 higher with it, erasing a big chunk of Thursday's weakness.
Okay, so that's the noise. Or at least it's the momentary burst of enthusiasm. It's loud, it's visible, it feels powerful. But the second you look past that Nasdaq screen, the whole story just kind of collapses.
And that's the structural signal we just cannot ignore. We are deep into a decisive global risk-off rotation. This is extending Thursday's weakness with terrifying conviction. This is not just taking profits, this is institutional de-risking.
And the scope of it, that's what makes it structural, right? It's not anecdotal. We didn't just see a little dip in Asia. We saw a sharp, comprehensive rout, the Nikkei 225, the broader MSCI Asia-Pacific Index.
Both plunged by over 2%. Over 2%. When you see indices falling by that magnitude globally, it tells you the market is pricing in something much darker than just one great NVDA report.
Something fundamental.
Precisely. That magnitude suggests investors are moving past the headline euphoria. They're realizing the underlying AI bubble fears are very persistent. And what's more, the concern about fading global economic momentum, the whole reason the Fed is easing in the first place, that's now taking center stage. So this de-risking means large funds are cutting their exposure, assuming the euphoria is temporary, but the weakness is fundamental. European markets, the DAX, the FTSE, they are solidly in that decline. That sets a bearish tone right into the U.S. Open.
So we have this perfect battle. The U.S. market says AI saves us, but the rest of the world is screaming that entire tech trade is vulnerable and we're getting out.
Right. To figure out who wins, I think we have to look past equities for a second and go to the engine room, fixed income.
We absolutely must. I mean, if the world is really in a risk-off rotation, the first place capital should flow is U.S. Treasuries, right?
Mm-hmm.
That should drive yields lower, give growth stocks a tailwind.
That is not what we're seeing at all. It's the single biggest surprise this morning. And this, for everyone listening, this is the critical signal you need to watch. We are seeing this stubborn persistence of robust U.S. Treasury yields. They're trading near that 4.1% to 4.14% range. The 10-year yield is refusing to collapse.
Okay, so why is that happening? I mean, the Fed has already delivered its second rate cut. Shouldn't the bond market be celebrating that?
Well, the rates market is telling us something very nuanced here. They're digesting the fact that the recent jobs data, while it showed some cooling, it failed to deliver that unambiguous signal of a rapidly collapsing labor market. The bond market is basically saying, okay, we see the Fed is easing, but that easing cycle might be slower and shallower than we hoped.
And that nuanced slower easing, that's the death knell for high multiple growth stocks that desperately need that cheap liquidity. So what are the definitive lines in the sand for traders watching yields today?
You need to focus on the boundaries. A definitive push above 4.17% on the 10-year. That spells massive, immediate pain for gold, for growth stocks, for any of it. That validates the higher for longer thesis. On the flip side, a sustained move below 4.05%, that signals the bond market is finally forcing that aggressive Fed easing narrative back to the forefront. And that would give tech a much-needed breath of fresh air.
All right, let's look at the safe havens, starting with the dollar, DXY. With global sentiment tanking, the dollar should be strong, correct?
Absolutely. The DXY is currently stable, maybe slightly supported, trading around 100.24. This is textbook risk aversion. When the world sells off, capital runs back to the U.S. dollars, the cleanest dirty shirt. That flight to safety, combined with those elevated yields we just talked about, keeps the dollar firm.
And that firm dollar plus high yields is just crushing gold.
It is structurally weakening gold, yes. The price action confirms it. You have the dual headwinds of a stable dollar and those elevated real yields. Investors can get a decent inflation-adjusted return on a bond, so why hold a non-yielding metal? Gold bulls need yields or the dollar to break down. Right now, it's a sell-the-rally asset.
And finally, a quick touch on oil. WTI is around $60.60 a barrel. What's the story there?
It's screaming clear demand-side pressure. The global equity sell-off isn't just a number on a screen. It's a direct translation into fears of weakening global economic activity. If Europe and Asia are de-risking, their energy consumption forecasts are softening. That macro concern is just outweighing any immediate supply risks right now.
Okay, let's move to the immediate, highly actionable technical checkpoints based on this whole conflict. NVDA euphoria versus global fear. What are the lines that just cannot be crossed? Let's start with the ES.
So the battle for the E-mini S&P is right around Thursday's high. The key resistance, that near-term ceiling, is 4,950. A sustained breach above that level confirms strong momentum from the bounce, and critically, it's going to trigger stops from the shorts. That's the breakout marker.
But if that global weakness starts to really infect the U.S. session, where's the ultimate line in the sand for the bears?
4,820. We cannot lose that level. That is the critical support. A failure there signals a complete collapse of all that overnight momentum. You get a rapid de-risking, and crucially, you fill that gap we created. If 4,820 breaks, the structural risk-off signal has won the day. The NVDA surge was just a bull trap.
And moving to the center of the storm, the Nasdaq 100 futures, the NQ.
Since the NQ is the direct beneficiary of all this AI hype, the focus is just on holding the support zone from the overnight rally. That's at 24,765. That zone is essential for structural integrity. If NQ holds there, the focus immediately shifts to clearing the 2025 contract high. A move above that would signal a truly parabolic break.
Okay, now for the volatility fuses. We have two big economic catalysts today that are going to determine which side wins this technical fight. First, and the big one, is at 8:30 a.m. ET U.S. real earnings.
This number is critical. It feeds directly into that whole wage price spiral narrative and the Fed's credibility. Remember, the whole reason the Fed is easing is because they believe the labor market is weakening enough to cool inflation.
So just quickly, can you clarify why a hotter number is so poisonous for the market right now?
Of course, if real earnings sow, wage growth after inflation comes in hotter than expected, it means workers have more purchasing power, more bargaining power. That's the heart of the wage price spiral the Fed is desperate to crush. A hot number contradicts the Fed's entire dovish story. It would suggest inflation isn't beaten and would put tremendous pressure on yields to spike higher. It puts the whole easing cycle on trial.
And conversely, a cool number provides just massive relief. It validates the Fed's view.
Exactly. Then the second data point is at 10:000 a.m. ET. It's the final UMich consumer sentiment. The headline matters, but the crucial focus is on the breakdown of inflation expectations.
Weak sentiment with high inflation expectations. That's the classic stagflationary risk. Bad for Main Street, bad for Wall Street.
And we also have to touch on the contradictory signals in energy. On one hand, U.S. sanctions on Russian oil companies take effect today. That's a supply-side risk. It should push oil higher. For Desti, we also have headlines suggesting progress on a potential peace deal in Eastern Europe. That's demand and sentiment relief.
So a supply shock being immediately counteracted by potential geopolitical relief, how should a trader even prioritize that?
In the very short term, the algorithms usually react to the supply disruption first. But a credible sign of peace instantly overrides that. So traders should watch the WTI-Brent spread and the direction of the energy sector ETS, the XLE. A decisive move in the XLE, one way or the other, will tell you which narrative is winning.
All right, let's put it all together. Let's synthesize this.
Okay, so let's synthesize everything. We have the equity battle, the sticky yields, critical data points. But the overriding structural framework, it's still the Fed. They've delivered their second consecutive 25 basis point rate cut. This decisively marks a shift into an easing cycle. They're trying to support a weakening economy.
So we have a safety net. The Fed is easing, but also a structural fear, because the reason they're easing is that the economy is weak. What's the primary hypothesis for institutional capital today?
Our primary hypothesis is unequivocal. The Fed put is on trial. The session today will likely see a continuation of that AI bubble rotation. Capital is going to move from high-growth tech into defensive, rate-sensitive, lower multiple sectors. That NVDA bounce, it's an ideal filling opportunity for funds trying to de-risk into strength. The market fears the reason the Fed is easing.
So if you bought into that NVDA excitement overnight, the takeaway here is pretty clear. Tech is a source of funds today.
Absolutely. This is a sell-the-rally environment for concentrated tech, especially the Nasdaq, until that bubble fear subsides. Or, unless that 8:30 a.m. data comes in extremely weak. But absent that, watch for a technical breakdown. The Nasdaq is likely a source of funds.
So where should that money be flowing? This is the critical, actionable takeaway. Where does capital seek safety in this kind of environment?
This is the rotation trade. You look for relative strength in sectors that benefit from falling rates and provide lower volatility.
Give us the specifics. What are we looking at?
Start with utilities, XLU and REITs, VNQ. They're highly sensitive to rates. For REITs, falling rates lower their cost of debt, which expands their margins. Utilities are defensive, they're debt-heavy, so they're direct beneficiaries.
Makes perfect sense. And what about traditional value, like financials and industrials?
Financials, XLF, and industrials, XLI. These are traditional value names that often show relative strength here. Financials can benefit from a steepening yield curve. Industrials are a little more insulated from the global tech mess and act as a barometer for stable domestic growth. Capital is prioritizing stable yield and lower multiples today, not explosive growth.
And before we sign off, let's just quickly check on that consumer bellwether. BJ's Wholesale Club, BJ reported pre-market.
Yes, absolutely. The U.S. consumer has been the backbone of this whole thing. That BJ's report will give us immediate insight into discretionary spending. Any weakness there, any hint the consumer is finally buckling, that would just amplify this entire risk-off environment.
This has been an incredibly dense analysis of a really complex session. We have AI versus global sentiment, all being arbitrated by the Fed's reaction to that 8:30 a.m. data.
The fate of this AI rally hinges entirely on whether that data confirms the Fed's dovishness, or if it proves inflation is more stubborn than they thought.
So here is the final thought for you to carry into the opening bell today. Consider the immediate fractional reaction of the U.S. 10-year Treasury yield to the 8:30 a.m. real earnings data. That reaction, how quickly and decisively that yield moves, will be the clearest indicator of whether the market truly believes the Fed, or if it fears they cut too soon. That rate movement is the ultimate referee.
That's the bell. Thanks for listening to Bulls, Bears, and the Bell.
Good luck out there.